Good evening, everyone. Thursday, September 17th. This is a special Thursday evening edition of the Anderson Report. I am Tim the Source Anderson. This is my YouTube channel titled appropriately The Anderson Report. I also broadcast on Periscope under the channel TJ Anderson 12, and my Twitter handle is TJ Anderson 1. I want to thank everyone for joining the broadcast. And if there are any new uh, viewers this evening, you can subscribe on YouTube by hitting the red subscribe bar, and of course the bell right next to it to get notifications of when the next broadcast will be. Jen, it's great to have you in the chat. Thank you so much for watching the program. I know you've been a big supporter, and we certainly appreciate it. So, uh, John, welcome. And so today, almost a little bit of a reverse action from yesterday. We had follow through to the downside from the sell off that we had late in the afternoon on Wednesday. Markets started out quite weak. There were a couple of rally attempts during the morning; those failed. The Dow was down well over 1% at one point in time. NASDAQ was down close to 2%. S&P was down maybe 1.5%. And then we had a fairly sharp rally during the last hour, 90 minutes of the day, the opposite of what we saw yesterday. It certainly was not enough to get markets into the green on the day, but it cut some of the losses we had from the morning and midday, maybe in half. And there were actually a couple of bright spots that we'll get into in a little bit. But the overall, the Dow Jones Industrial Average lost 0.5%, closed above the 28,000 level at 27,900. The NASDAQ composite, almost a mirror image in the final stats from yesterday. It was down 1.3%, well off its lows of the day, but still a decline nonetheless to close above 11,000 at 10,000, a little over 10,090, 10,090.10 to be exact. And the S&P 500 finished with a loss of a little bit less than 1%, down 0.85% on the day, a decline of 28 points to close at 3357. Turbine, I wouldn't say that the markets are necessarily crashing. I would say that the stocks and the sectors of the market that have had exaggerated gains are experiencing some selling, um, and that there are definitely areas of the market where some of that money is going into, and it certainly is not what I would call an across the board route. Um, the advanced decline stats were only 3-2 negative, three stocks declining for every two that advanced. Certainly not a sign that the market is crashing or having what we would call a rout. Yes, it's a correction. It's a very well deserved correction, particularly in the mega cap growth stocks, and particularly in the mega cap growth stocks in the technology sector. Just to give you one little snapshot of that, Tuesday after the close, Federal Express reported very good earnings, their best quarterly profit report ever. The stock then rallied on Wednesday 6%. On the same day, Adobe Systems reported very good earnings. although they did not raise guidance and they left their projections for the fourth quarter and for next year pretty much where they had been. Adobe Systems, which has had a very strong rally along with a lot of other um, uh, technology stocks in either the information technology or the communication services area that have been uh, prime drivers of what we have called the internet traffic trade. Adobe Systems sold off 4.5%. So both stocks had great earnings. Federal Express went up 6%. Adobe Systems went down 4.5%. They were selling Adobe as well as a lot of other tech stocks on the news of their earnings. And there's very likely one other dynamic involved. Bear with me one second. And that other dynamic is that we have a very hot IPO market just developing over the last 2 weeks. And the forward market is very strong also in the technology space, particularly, and in anything to do with the internet traffic trade, with Airbnb scheduled to come public before the end of the year, Palantir, which is Peter Thiel's multifaceted data management and data analysis company coming public before the end of the year. And of course, we just had this cloud computing company that everyone was very excited about called Snowflake come public 2 days ago. Price Tuesday at the end of the day went up 110% on Wednesday, pulled back a little bit today, but still Snowflake with a 10% decline today, still closed at $227, over 100% higher than where it was priced at $120. So, what happens when you have a very hot IPO market in at least one sector of the market, or specifically one sector like technology, is that a lot of funds that anticipate that they are going to be buying. Yes, exactly, Andrew. That was the original price estimates were maybe about $80 for Snowflake. That was only maybe 2 weeks ago, maybe 2.5 weeks ago. Seriously, yes, Turbine. The stock is called Snowflake. It is a cloud computing, cloud management company, um, and that is the corporate name. The symbol is SNOW. So when you have a lot of when you have a very they call it a forward calendar. When you have a forward calendar in the IPO market that is loaded with stocks in one sector, like technology, which is what we have right now, uh, it's very likely that a lot of big funds that have big gains and that are heavily weighted in a lot of the mega cap tech names and a lot of the names that have been driving the internet traffic trade that have twofold, threefold gains on the year. What a lot of those funds will do is they will pare back some of their holdings in those stocks because they anticipate buying large stakes in these what are going to be these technology companies that all of a sudden have publicly traded stock after their IPOs, and they have to make room for those stocks in their portfolio so they don't get overweighted beyond what their investment charter calls for in one sector of the market. So uh, I think that some of the selling has just been well deserved profit taking. I think some of the selling may be in preparation for a lot of the IPOs that are coming for the sector. And it's even possible that, some of the selling may be just because some managers feel that the mega cap growth sector of the technology market has some uh, uh, stressed or stretched valuations, stretched beyond where people feel they should be. Maybe they've reached their price objective for some managers, and maybe some managers just feel like these stocks have just run a little bit too far too fast. Sure, I'm going to buy these other IPOs, but before I do that, I've got to lighten up a little bit on what I already own. So, just to go over the data again, the Dow Jones Industrial Average down 0.5%, really not that big of a sell off. It had been down over 300 points early in the day. It finished down 130 points. The NASDAQ composite down 1.3%, the S&P down just under 1%, the Russell 2000 closed down just over 0.5%, although the Russell did close near its highs of the day. S&P not quite, but they all closed well off their lows. And today, the advanced decline at the NYSE, there were three stocks that declined for every two that showed gains. That's what we call market breadth. And that is certainly not indicative of a market that is just being sold across the board indiscriminately, and maybe what we would call certainly not a market rout. Okay. And even in NASDAQ down 1.3%. There were four stocks that declined for every three that advanced. So clearly, the majority of the selling that accounted for the 1.3% decline in the NASDAQ composite was largely due to high cap names in the NASDAQ composite. In terms of sectors, energy yesterday gained 4%. Now, there's been many times in the last 6 weeks where energy will gain 3% one day, lose 1.5% the next day. Yesterday, energy gained 4%. Today, energy gained 0.2%. Crude oil, which had traded down to a 37 handle after that sharp sell-off we had following September 2nd, crude oil plus 2% today to $41. We mentioned numerous times in August, we like crude oil being above the $40 level. I don't think it's going to make gasoline spike at that price level. It might go up, 5 to 10 cents, depending on what part of the country you're in. But it's also very good for the energy industry and good for the profitability of a lot of those energy stocks, like the frackers and the shale producers that are kind of on the margin when the price of oil dips into the mid to high 30s. So, a couple of other sectors that acted better than the major averages: the industrials plus 0.2%. The material stocks, we've mentioned on numerous occasions. The material stocks up 0.7%. I just think that's a sign that investors are rotating in to other areas of the market that they think are going to be beneficiaries of a continued improvement in economic growth going into the end of the year. You would not see industrials and materials outperforming if people thought that the economy had seen the best improvement we're going to see before the end of the year. These are cyclical names in the industrial sector and the materials sector. In fact, they're early cyclical names, meaning that investors usually go in to those areas of the market when they feel that we're on the verge of significant economic growth. And the transports, yes, Andrew, that's the perfect lead into what I was just going to talk about. The Dow Jones Transportation Average closed at 11,552. It closed at 11,555 yesterday. I mentioned this yesterday. On September 2nd, when the S&P 500 and the NASDAQ composite posted all-time highs on September 2nd, that follow through trade from Tesla splitting and Apple splitting, that just pushed the market even higher the first couple days of September. Sometimes it's new money at the beginning of the month. Sometimes it's people maybe chasing performance from the prior 2 months. July and August were very strong months, but the S&P 500 is down 6.5% from that level. The NASDAQ composite is down 9.5% from that level. The Dow Jones Industrials is down maybe close to 4.5% from that level on September 2nd. The Dow Jones Transportation Average is higher right now than where it closed on September 2nd. The transports are always considered to be early cyclical stocks, meaning that investors go into them when they feel we're on the verge of further significant economic growth. We've had a lot of economic growth in the data, but coming off that horrific decline that we had in right after the economic shutdown due to the coronavirus, and that was the decline in late March and April and the first part of May. So the Dow Jones Transportation Average closed today at 11,552, really unchanged on the day. I mean, it was down 3 points. Okay. The all-time closing high for the Dow Jones Transportation Average is 11,571, just a shade under that. 11,571 on September 14th, 2018, literally 2 years and a week ago. Okay. So that's the transports, obviously, are the airlines, the truckers, the rails, and a few transport companies, delivery companies. Probably, I don't have the list in front of me, but Federal Express and UPS. So that is something to watch very carefully going into the end of September and going into the beginning of the fourth quarter. There's a little over 2 weeks left in Q3. And we will just, it'll be interesting to see if people continue to sell technology going into the end of the quarter, or maybe those investors that have been lightening up on their positions maybe want to dress up their portfolios a little bit before quarter end. Now, one other stock that I just want to mention, I mentioned it yesterday, General Electric, a long time member of the Dow Jones Industrial Average, taken out a few years ago. Clearly, it had a lot of issues, never really recovered from the global financial crisis. The company had a lot of weird things going on, almost kind of like being run by a hedge fund a little bit. They probably got the right guy running it now, the guy that used to be at Danaher. The stock gained 10% on Wednesday. Typically, you would see a stock pull back after that, after a 10% gain. But General Electric added another 4.5% today, closed at $7.05. Clearly, the stock had been really just way back on its heels, had traded 13-ish in February before we had that big sell-off in response to the coronavirus economic shutdown. It's still just over half of that valuation, very tied to the auto space, the aerospace industry, and the airline industry. We'll have to watch if this is maybe a little bit of a short covering blip in General Electric, or maybe there's something a little bit better going on the fundamental side. So we are banks concerning enough, though? Well, Andrew, banks have had a very hard time, like energy, following through with anything more than a 1 to 2 day rally. They go up for 3 days, they go down for 2 days. They go up one day, they go down the next day. They have a 4 day rally, they have a 3 day decline. But I will say that following, I, I I'm not expecting a sharp rally in the banks. And of course, I have to temper anything I say by reiterating that I am uh, I am not a registered analyst. I have to be very careful about how I talk about individual single stock names. I can talk about sectors a little bit, but I am a registered member of FINRA, being that I do work for a broker dealer. And so I cannot say anything that gives somebody the impression that I am recommending individual stocks or saying that you should buy stock A or sell stock B or anything like that. When I talk about General Electric in the light that I do, it's just pointing out what the stock has done over the last couple of days because it's still General Electric, even though it's not in the Dow Jones Industrial Average anymore. And I think it's worth mentioning that the stock has had close to a 15% rally in 2 days. Now, that being said, we mentioned crude oil. Yes, Andrew, back to the banks. Um, with the speech that Chairman Powell gave at the virtual Jackson Hole conference a couple of weeks ago, he stated that they were going to let inflation run hot for a while before they even consider raising rates. I mentioned last night, I think that, the Fed, of course, has a very long term perspective on things. For a while does not mean a few weeks or a few months or even a couple of quarters. I think for a while in Fed language, and again, Powell is not a guy that is a Fed speak type guy like a number of the previous Fed chairmen were. Um, I think for a while means like a year. And he said that probably their best estimate is, you know, 2023 rates are going to be zero. Now, look, even if inflation did spike and did maintain a move above 2% for a while, and let's say they raised rates half a percentage point over a couple of meetings, you're still got historically extremely low rates. Um, and I think he's trying to be very realistic. I think he's trying to temper people's enthusiasm a little bit. I have no issue at all with the things that he said uh, at the his statement and then press conference the other day. I think some people in the market get a little spoiled on occasion. They want the Fed to say, "Look," there were a couple of comments in the press that some Fed watchers were a little disappointed that he didn't say they're going to extend the um, maturity, the average maturity of all the government bonds that they're buying. Well, look, I mean, if you want to be real picky, okay, I get it. But I don't think that that was worth, and clearly the market by the end of the day today did not think so either. I don't think that that was worth a 1.5 to 2% decline over a period of 2 days in the major market averages. You know, I think that look, the Fed by nature is not a place that's going to light the world on fire with their vernacular. Okay, and Powell himself is certainly not a guy that's really is a has a particular amount of effervescence to his delivery when he presents or when he gives his statement or even in his Q&A, and I think that's cost him a couple of times. Yeah, Andrew, I don't agree with that. For a while means years. Yeah, look, it means at least a year, could be 2 years. But again, if they get the bump in inflation and it holds for 2 or 3 quarters, they might react to it. So, my point is that has helped the long end of the yield curve move to higher rates. And I don't think that's a negative because what that does is that steepens the yield curve, and that's good for banks. I think we've seen numerous times over the last year when the long end of the yield curve has gotten extremely low, when the 10 years gone down to a yield below 0.6%, threatening 0.5%, and you've seen banks then sell off during that time period. Okay, the 10-year yield yesterday was 0.686 or 688%. The 10-year yield today gave up a few thousandths of a percent, still yields 0.684%. That's a much steeper yield curve than what we had 6 weeks ago. And I think that if it can hold that level and maybe get up above 7%, maybe even move toward 0.75%, that will help the banks. They're certainly not going to rally the way the tech stocks did coming off the lows in March, but I think that it would help the banks to have a steeper yield curve, and that's been one byproduct of Fed Chairman Powell's delivery at the Jackson Hole conference 2 weeks ago. So we did have economic data today. We did have the weekly jobless claims numbers. Came in at first-time jobless claim filers, 860,000. It was a drop of 25,000 from the prior week. I think it needs to drop a lot more than that. We need to get down below the 800,000 level. I'd love to see a 600 handle on that. Maybe we get that over the next few weeks. And but we did have a significant drop in continuing claims. So that's a positive. Continuing claims dropped by a little less than a million. I think maybe just under 900,000. They dropped to 12.6 million from about 13.45 million or something like close to that. So continuing claims at the lowest level they've been since April, when from late March they built up and eventually got up to what was it? Was it close to 20 million? It might have been. So continuing claims 12.6 million. We'd like to see that get down to maybe sometime in August, in October, that can get under 10 million. That would be a very positive sign. So it's this weekly jobless claims number. It's going down grudgingly, but it's heading in the right direction. The continuing claims number, we'd like to see it fall more, even more, but it's heading in the right direction. We did have a building permits number, housing starts numbers. Those came in maybe a little bit lower than expectations, but look, those numbers have been big for a few months now. Mortgage rates are very low. I think that they're a touch below 3%. You've still got a little bit of shortage in the housing market. You've still got a lot of people that want to move out of the big urban areas, maybe to the suburbs or beyond. We see, and I think that even though the building permits and the housing starts number weren't quite at the levels of what the estimates were or the expectations, the consensus, I still think they're very good numbers. And keep in mind that just the day before, we hit an all-time high on the National Association of Home Builders Housing Market Index of 78 for the month of August. So, some really good questions in the chat tonight. Will we see a similar reaction to the election like 4 years ago. Um, I think we'll see a reaction. I think it'll probably be a little bit different. I certainly think that if President Trump is reelected, you will, and it becomes clear on late on election night or early the following morning, you will not see a uh, a 5% or a 4 to 5% sell off in stock index futures overnight at some point in time, like you did last time. He's much more of a known commodity uh, in terms of what his policies will be than he was 4 years ago. But then will you see a big, strong stock market rally after the fact? Well, look, that's 45 days from now. But it depends on where the market is the week before the election. If you know, if it, I think that the worst scenario for the market would be if, because of the large amount of votes that are potentially going to be cast through mail in voting, that if the outcome is very uncertain for more than 2 to 3 days or 3 to 5 days, and if it's going to create potentially a legal quagmire where vote counts are going to get challenged in key battleground states, the results of which will potentially um, affect um, which candidate is going to get to 270 electoral votes. I don't think the market will like that at all, and I think that you will have some selling until you have a definitive outcome. In 2000, when you had the issue with the Florida recount, and that dragged on to, I think it, I think it dragged on into December. The market, the S&P 500, declined 11% from election day to the point where there was finally the final Supreme Court decision that Florida had to stop counting their votes, and that meant that uh, Bush 43 had won the presidency. That went on for 6 weeks, maybe after the election, maybe a little bit less than that, maybe 4.5 weeks, 5 weeks. I don't know. I don't have the exact time frame. I know it went on for at least 4 weeks. The S&P 500 declined 11% during that time period. I think if this election outcome were to be dragged on like this, the market would not like it. So, Andrew, that's my question. That's my answer to that question. Now, look, tomorrow, one other thing that I want to mention, I was going to mention it yesterday and I didn't mention it, but uh, the Big Ten reversed their decision from August 21st, where they held a vote where the presidents of the 14 conferences voted 11-3 not to scrap the entire football season this year. Before that, they had said they were only going to play conference games, and then they voted to cancel the entire season, despite the fact that the SEC is going to play, the Big 12 was going to play, and the ACC was going to play, and Notre Dame was going to play, and some other major independents were going to play. That decision was a public relations disaster for them that would have turned into a recruiting disaster had they not reversed it. It would also have been, and it will even it would have been an economic disaster for the athletic programs of all the universities in the Big Ten, and will still be a major hindrance for them, with them playing an 8 game season down from a what 12 or 13 game season. I think the Big Ten commissioner was trying to do a major power play during that vote. I had read a couple of stories that he had basically told presidents which way to vote, because regardless of how they ended up voting, that he was going to make sure the season would get canceled anyways. The blowback was so severe and so one-sided from parents of players, even coaches, and even current Big Ten coaches, and from everyone involved in the school, the alumni associations, et cetera, et cetera. When you have when you have a lot of these stadiums, when you have stadiums at Penn State and at the University of Michigan that hold over 100,000 fans, and at Ohio State and Wisconsin and other major universities that hold over 85,000 fans. And you have schools like Nebraska that came with a long football tradition that came into the Big Ten just maybe, 6 or 8 years ago, or maybe a little bit less. And now the Big Ten does this. These They were at risk of schools wanting to leave the conference. They were at risk of players looking to that were franchise players for some of the big schools in the conference, looking to transfer to schools that were going to play. And believe me, those schools would have taken them in a heartbeat, and and it would have just crushed their recruiting efforts for, I think, 5 to 10 years. So they reverse that decision. They're going to play an 8-game schedule. You will have tailgating of hundreds of thousands of people outside stadiums. Sure, there'll be some social distancing. I don't know what the fan situation will be in the stadiums, but you will certainly have uh, uh, tailgating, and that is a huge, almost immeasurable economic impact to local communities around where these universities are. So that's a positive for the economy going into the fall. Now, tomorrow is a Friday. It's a quadruple option expiration, expiration of single stock options, index options, futures, and is also an S&P quarterly rebalancing for the third quarter, all wrapped into one day. It will be one of the highest volume days of the year. There will be very high volume on the opening, and then there will be very high volume in a lot of individual names in the last, let's say, 15 to 30 minutes of the day, heavily concentrated in the last 10 to 15 minutes of the day. I'm not saying that you'll see extreme volatility, but you will have very high volume in a lot of names as fund managers have to that mirror the S&P 500, have to rebalance their um, portfolios to mirror where the S&P 500 will be at the end of the day tomorrow. And they do not do that. They do it at least a week before the end of the quarter, because they don't want to do it on the last day of the quarter, just in case something weird happens and trading gets halted that day or something else. And then they're like really in a bind because they didn't do the rebalancing. So tomorrow will be a very large volume day due to the quadruple expiration of option contracts and the rebalancing of the S&P major averages, not just the S&P 500, but also the 400 mid cap and the S&P 600 small cap averages. So, that's pretty much all I have tonight. I really appreciate everybody joining the program. And if you have not yet subscribed, please hit the subscribe bar and then hit the little bell next to it on YouTube, on my YouTube page, to get notification of when the next broadcast will be. I will almost certainly have a broadcast tomorrow. It very possibly might be at 7 o'clock, but check sometime between 3 and 4 to get official time notice of when that'll be. I'm Tim the Source Anderson. This is my YouTube channel, The Anderson Report. Thank you, everyone, for joining us this evening, and we will talk with you again tomorrow. Great action in the chat tonight. I really appreciate all the questions. If you have any questions after the fact, shoot them to me on Twitter, and I'll either respond to you directly or cover it tomorrow. Thank you and good night. Network One, it's great to have you in the chat. Thank you.